Welcome back to another Cottonwood Wealth Strategies tidbits. We're looking at some market volatility today and talking about how some of the growth in the S&P 500 and the equity markets might be driven, will be driven a lot by a few individual companies, and how that probably won't continue going into the next 6 to 12 months.
Yeah, absolutely. I think we all need to be cognizant of that, right? Look, it's great. The markets have been up. The S&Ps ran up a lot in the last year and a half. It's great news. Everybody benefits by that. But remember, when we have a situation that we have now, which is 7 or 8 of those 400 or 500 stocks amount to about 50 or 60% of the returns on the S&P, it's something to be a little bit leery of or concerned with, right? That tends to lead to more volatility, especially when you have valuations stretched to the extent that we believe they are at this point. It doesn't mean it's terrible. We're not abandoning the markets. That's not the issue. But we just need to make sure that people are aware of where those valuations stand relative to historical standards and the level of concentration. So again, those 7 or 8 companies, we all know who they are, have made up the gigantic portion of the return that we've seen for the past year and a half. We just need to be cognizant of that.
Right, because really, when you get into it, that's unsustainable, right? Just those few companies can't drive the overall return of the entire S&P, the entire economy. So there has to be a little bit of a reversion to the mean there. Something has to happen so that either the rest of those companies' earnings can catch up, or maybe the actual values of the shares go down. But something has to happen so that it meets more in the middle there, and we're not just continually running up without real data behind it that backs up the value of those shares.
That's absolutely right. So you have a couple different options, right? We could kind of level out in terms of the evaluation of the S&P, and the rest of the 490 plus companies catch up earnings wise,
Right.
Or you can have a correction, 5 to 10%, whatever the number happens to be, pull back to bring it back to, as you said, the reversion back to the mean. Either one will be just fine. But again, it's just the expectations of the ordinary investor need to be tamped down just a little bit. We've had extraordinary returns for the past year and a half or so. We don't expect that moving forward. Are we negative? No, but we're cautious. Longer term, we're very positive. Again, the economy looks fairly strong. We're slowing in terms of growth, but we just need to be cognizant of where valuations are. But it doesn't mean there aren't opportunities out there, because there are.
Right. And at the end of the day, you don't want to run away from the public side of things,
Right.
Because for all we know, we could be wrong about some of those things, right? Equities still could go up by a little bit. They could drop down, but history also shows after equities go through some sort of a correction, the flip side of that, the next 12 to 24 months after those periods perform really well again. So you don't want to abandon those public markets, but the point we're trying to make really is we just shouldn't expect the kind of returns and the crazy upswings that we've seen over the last 12 to 24 months.
Yeah, particularly in the near term, right?
Right.
Longer term, again, we're definitely positive. But remember, too, that creates opportunity otherwise. So again, if it's only been 7 or 8 stocks out of the S&P, we're looking at the other 490 plus.
Yeah, absolutely.
There's got to be opportunity.
Absolutely. Well, again, thanks to everyone for listening, talking a little bit about market volatility and maybe what to expect out of the equity markets with a few of those main stocks driving a lot of the growth. Stay tuned for more information.